Hi, it's Susanna, and today I'm making a video which is one part educational and I suppose one part commentary as well. And the specific purpose of this video is to show you how you can calculate an annual percentage rate of growth on a property. Now, if you are the person who gets really annoyed and offended if anyone dare say that property can go down in value, or even that it has been growing in Australia in particular too quickly, too high, too fast, then you're probably going to want to click over now because this video will just annoy you because it will give you factual information to support those ideas. And if you are opposed to those ideas, you will hate this video. So go ahead and give it a thumbs down and click away. And for those of you who aren't offended by evidential facts and mathematical truth, well then stay tuned. I will teach you something that hopefully will be of use to you when you're looking at buying or selling property. So the first thing I wanted to do is just show you this gorgeous house here. Isn't it lovely? It's really nice. Click through, look at those polished floor. Very tasteful, very beautiful. I like this house a lot. Who wouldn't want to live here? Well, you might not want to live here. This just came on the market today if you don't have a spare 1.35 to 1.45 million to spend. But if you do have a 1.35 to 1.45, you might want to join them for their VIP champagne breakfast on Saturday, the 10th of November, because you will be able to view this lovely property there. So what I've done is I've looked at this property and I just put in the address. It's Newport. I like Newport because I used to live there. I put it into the search criteria, and here's a picture of our lovely house looking slightly different. And it was last sold. We've got some evidence, some history here. It was last sold for $860 on the 28th of July. I've only got that one image, but I think if you're of the same mindset of me, you would agree that it probably didn't look as good as it does now when it was sold back then. It also looks like they've added a bathroom, because here it says 3x1 and here it says 3x2. So let's assume that they've done a very tasteful renovation on that property. In the 2 years since they sold it, they purchased it for $860 in 2016. So this is just another website. This one's called On the House, and On the House estimates it would be worth $940, which is considerably less. But On the House might not know how beautifully renovated it is. And this is realestate.com.au, and they have not provided an estimate for how much this house is worth. All right, so moving into the calculator. I'll just see if I can move that over slightly to give you a better. I want you to be able to see this better. Maybe if I just, there we go. So what year was it purchased? 2016. What year are they hoping to sell it? 2018. Owned for 2 years. Purchase price of $860. Sale price, well, that we don't know, but we've got to put something in. So I'm going to put in the lower end of their asking price. 1350. How many zeros? 4 zeros. So that's a tidy overall growth of 490,000. Now, obviously, they've spent money, which would increase what they've paid, but I don't know how much money they spent, so I'm just going to leave that at 860. So that shows an overall growth over 2 years of 57%. So not almost double, 57% is how much this tells me it has grown over those 2 years. And each year, and this is the money shot, people, this is, take a screenshot of that and you can use it in your own calculator, or just send me a private message and I will send you this calculator if you want to use it. But that's the annual growth, 25.3%. As I said, it doesn't take into account their stylish renovations. They might have, who knows, they might have spent $250,000 on those renovations to make it look that pretty, in which case they'd only be getting 10% growth over the 2 years. And this is an example of what they call manufactured capital growth, because if they just held the property for those 2 years, they probably would not be able to sell it anywhere near what it is now listed for, and they probably would not be having a champagne breakfast. So moving along, let's look at another property that has been held a bit longer and probably hasn't actually been renovated all that much in the time. Okay, so this is another one that's new to the market. It's Shellard Street, and it's up for sale for $730 to $780. And on the house, estimates it at $840, so that's actually higher than what they're selling it for. And on the house will tell you that it was built in 1980, and it doesn't have any sale price information, so we can check realestate.com.au. They actually reckon it may be worth $550 to $690, which is less than what it's listed for, and they do have history. So they've got March 2007, it was sold for $340. So going back to our trusty calculator, 2007, purchase price $340, and for a sale price, we'll just go ahead and use $730, which is on, again, the lower end of their range, which is what prices are selling for. What places are selling for. If they're selling at all at the moment, in Newport, Williamstown, Altona, this sort of area, they are selling at the low end, or they're typically not selling at all. There are maybe some exceptions to that with beautiful, stunning properties that are very unique. But for this sort of a place, I think if they got $730, they should be feeling very happy about that. But that would represent an overall growth of $390,000 over the 11 years that they owned it. And so, 11 and a half, but we're just going to say 11 just to keep it simple. So that's an overall growth of 115%, which means from what they purchased to what they are hoping to sell it for, it's grown over 100%. It's doubled. It's over more than doubled. And that makes an annual growth rate of 7.2%. Now, one thing I was going to do is I was going to see about Googling annual growth rate of property in Australia to see if I could find anything that showed what would be realistic. Cool. Nationally, the median has been 6.8 over the last 25 years. But if we go longer term than that, we'll find it's definitely not as high as 6.8. It just isn't. So what if we thought maybe 5% over the long term? If inflation is about 2.5% to 3%, maybe house prices grow twice as much as inflation. Maybe they grow by 5%. So what would be a realistic sale price if this property only grew by 5% over those 11 years? So that's where we could start to play with the calculator and see maybe this property is only worth $580 or $600,000. $580, okay, there you go. There's your 5%. So it starts to give you an idea of how potentially unrealistic sellers' expectations are at the moment. Certainly they want to see that, if a neighbor property sold for a high amount, that they can also sell for a high amount. But if you're purchasing, maybe just going on what has sold recently is not going to be that much of service to you. Maybe it would be good for you to think about what's realistic in the longer term. And even, was there another? We could plug this in as well. 1992, 110,000 on this property. And so based on that, even if you paid $580 now, that's 6.6%. So maybe $500 is more realistic. Nope, that's still overpriced. Maybe $450 is more realistic. No, that's still overpriced. Maybe $400,000, which sort of starts to give you the idea that this person who purchased it in 2007 may have already been paying well above what was a sustainable growth market rate level at that time. So I just want to put that out there, that the prices are not based on any kind of a realistic long-term average. They're the fundamentals underneath the property growth, which is things like wages growth, population growth, that doesn't really support the level of growth that's happened in house prices. And there's a lot of things happening now with the banks reducing the amount of credit they're making available. Foreign investors have left, the market in droves, and there's other things that are happening, which now makes it seem that if you're a prospective buyer, you're the one that's taking on all the risk. If you bought this house for $500,000 and that seller experienced a very generous growth rate, it could come down to $400,000 in the next couple of years that you own it, and you will have $100,000 wiped off of your equity. And so I definitely, would tell people, if they're looking to buy a home or invest in property, proceed with caution at the moment, because there's been a lot of rhetoric about you can't lose money. There's been a lot of speculation driving up the market, but it's not sustainable. And it's all but stalling now. I mean, if you have a look at what's selling, there's not a lot selling. For how many properties are coming on the market versus how many are leaving the market, it's not going good. Look, this is the last one that sold. I'm making this on the 8th. The last one that sold was the 1st. There's another one on the 1st of November, 23rd of October, 21st of October, 19th of October, 19th of October. But if you look at what's available to buy, I think about 4 came on the market just today. That one's new today. That one, I think, is today or yesterday. So they're coming on much faster than they're leaving, which indicates it's a buyer's market. And I'm not going to bang on about it. If you want this calculator, send me a private message and let me know. And there's that formula again. And I hope this video has been useful to you. Thank you and goodbye.